that by putting 19.9% down over 20% down will get you a lower rate and save you money on your mortgage? Well, part of that might be true, but I'm going to break down some numbers today. I recently had a client who went into the branch. They were looking to put 35% down. They'd recently sold their house, and they were told it's a lot better to put 19.9% down because it got them a lower interest rate and can save them money. Well, in the end, it could have cost them over $80,000. Luckily, we were able to have a conversation, and we're going to save them some money. And we're going to break down some numbers here and show you exactly what this looks like. So in column A here, we have a 19.9% down payment. The purchase price we're going to use here today, totally hypothetical, $575. We're going to show you 19.9% down. We're going to show you 20% down, what the differences are and how it's going to save you money. And then we're going to go to the 35% down and kind of really show you how you can really save money and where this client could have been cost a lot of money in the end. So let's start here. If you've got 19.9% down, the truth is, yes, you do get a little bit lower interest rate. And we're using these rates as today's rates. A 5-year might be the best rate for you. The 3-year might be the best rate for you. There's a lot of different options. These are just for illustration. We're going to show you exactly what it does. Rates are changing almost daily right now, so it's best to let's have a conversation if we want to know what those exact rates are. These are just for an illustration purpose. So today we're looking at a property purchased $575. $4,500 down property taxes, not in Toronto, so we don't have those extra land transfer taxes, but we don't have a first-time home buyer. So we're not looking at, the first-time home buyer rebates. That's going to come in down here in those land transfer taxes. So if we put 19.9% down, we get an interest rate of 4.99. If we put the full 20% down, that does increase our rates to 5.59. Now, what does that do for your payments? Yes, they are going to be a little bit higher, $63. It's going to cost you $63 on every monthly payment. We can break that down bi-weekly, whatever's best for you. What does that look like here, though? Here's where the real savings comes in of putting 20% down versus 19.9% down. There's a CMHC insurance. So that CMHC premium is going to be $12,896. Not only that, but if you look down here, there's taxes. So that's going to be lumped into your mortgage, this $12,000 up here. Down below, we've got taxes that are going to be added that you have to pay up front. So your closing costs, you can see here, your closing costs are going to go up a little bit. That's not good, right? So what happens here in the end, you have a mortgage amount of $473,000 versus $460,000. Now, what does that look like over the term of your mortgage? Well, you're going to pay a little bit more. Like I said, $63 per payment, and that does add up. So you're over the payments of the mortgage, it actually works out to about $3,700 that you're going to pay extra by having this 5-year fix at 20% down versus a 19.9% down. But the important numbers, what's going to be left over? So at the end of our 5-year term, what do your numbers look like? So option C, which is going to be here in this middle column, your balance at the end of the term is going to be $410,000. In this option, because you're starting with a higher mortgage amount, your balance is going to be $418,000. Now, if you want to do the math on that, you're saving yourself about $4,000 by putting 20% down, having a higher interest rate than putting down the 19.9% down. So if you're anywhere and they tell you, hey, save yourself some money, put a little bit less down, it's totally a myth, right? Run those numbers. If you want, let's chat. Let's go over these numbers. We can break it all down for you. What's the numbers going to be and how is it going to be different? Now, where we really save money? This client wanted to put 35% down. Now, one of the things that we work with, it's called monoline lenders. So some of the credit unions, they have different insurable rates. If you want to learn more on insured versus insurable versus conventional rates, I'll link the video. I've done another video on that where we can show that in the comments here, and you can watch what the difference between the two is. So with an insurable rate with some of the monoline lenders, now you can't get these at the traditional banks. You can get, depending on your loan to value, as that loan to value goes down, so does your rate because you've got a larger down payment. So for this specific instance, we got a 35% down. So they had $200,000 they were going to put down. We increased that by $1,250. Went to a $201,250 down payment. What that did is that brought them to 35% down and dropped their interest rate from that 5.59 that we would have gotten with a bank, and we got them at 5.04 that we can get them with a monoline or a credit union or something like that. We got them a significantly lower rate. Now, what did this do in the end? This dropped their payment. So they've gone from a $3,100 payment, even if they went here, a $3,108 payment to $2,464. This is the mortgage amount only. If we look down here, that has those property taxes built in. What's that going to do? In terms of savings, monthly savings on their mortgage payment saves them $42,500. $420. What's the balance at the end? You're down to $333,000 or $330,000 at the end of your term. And the total savings that we're looking at is $88,000 over the term of your mortgage. So the difference between what this client wanted to do, walked in, 35% down payment. They were told by their banker, and great people, they're just great people in the bank. They just sometimes don't know. And you gotta remember, they're looking for shareholders. They have profit for shareholders. I spent 17 years at the bank. Every meeting that we did, we talked about profit for shareholders. Does $88,000 help those shareholders out? Absolutely it does. This is what the banker knows. This is what they've been trained. This is what we were trained at the bank. We want to make their money for shareholders. Everything is about profit for shareholders. As a mortgage broker, I don't have shareholders. You're my shareholder. I care about profit for clients. So we're going to save $88,000 for this client. We have a little bit, they have a smaller mortgage amount. At the end of the term, they're going to be at $330,000 versus a end of term balance of $418,000. If you want to save money, if you want to look at the best rates, the best products, the best things that's available for you, let's chat. Book a call. Let's talk today before you cost yourself any money by going into the branch.